Well, nobody likes bear markets where the overall market's going down. Doesn't mean there isn't some individual, let's say stocks or whatever that market is that might be going up, but overall the broad market's going down. We like bull markets where mostly everything's going up because we're making more money. So the question is, when will the next bull market start? And there's just some things we should watch out for. So we're going to look at that and analyze that and kind of give you a feel for when this might happen as we come out of this bear market we're in now and start going into a bull market. Coming up on Invest Education with me, Mr. B. Welcome to the channel where we help you to learn fast so you can become a confident and successful investor. If that sounds good to you, hey, do consider hitting that subscribe button, checking out the free courses and the other courses we have in the description below. So bull market, when might it come? What can we watch for to start getting a feel for it? This might be happening, and if a bull market is just starting to maybe emerge, maybe we want to get in a little bit earlier and put some more money to play in that market. And again, all markets can have bull and bear markets. The cryptocurrency market and the bond market and the stock market, they all have their bull and bear cycles. So first off, when is a bull market sort of technically officially called? Well, a bull market occurs officially after a bear market, after there's been a 20% decline. So when there's a 20% decline from the most recent high of let's say like the S&P 500 for stocks as an example, when it drops 20%, that's a bear market. So when it comes back off the lowest of the lows, because it could go below 20% in terms of a bear market, it could go down 30, 40%. When it comes off that bottom and rises 20% from the previous low, the lowest of the lows, that's when you have a bull market. It's gone up 20% from the bottom, and now we're officially in a bull market. So what are some things we should watch for to see when this might be occurring? Maybe when it's up 10, 15%, maybe we're headed to a bull market, or certainly after a bull market and we want to feel more comfortable about that. Some things to look for, one would be, is the gross domestic product or GDP of, let's say, entire countries, is that growing, right? So when we measure recessions, we look for 2 consecutive quarters of negative growth for GDP, for overall economic activity. So if we start seeing GDPs that are positive, especially if they're growing quickly, that can be a positive sign that the stocks, which are more of a leading indicator, are headed that way, that we're headed towards some better economic good times. The other thing you'll start seeing is companies start having good earnings, right? They start having good earnings. They might be investing more in the company again. They might be hiring people again, as opposed to cutting people when things are bad. They might be starting to hire people or put more money into research and development. You'll typically also see the unemployment numbers start falling too. So if you're watching some economic news and you see that unemployment is starting to have a trend of falling, this can be an indicator that we might be having a better time for, let's say, the stock market and for better, entering into a bull market. See, right now we have high inflation, right? So we're experiencing high inflation. And so central banks fight that inflation with raising interest rates, right? So they raise interest rates to try to keep those rising prices in check and basically try to, in fact, try to get those prices to get lower, basically by hurting demand, by hurting us as consumers. So unemployment will rise, and companies won't be able to make as many investments because they would be doing at higher interest rates. So when interest rates are rising, it's designed to slow down the economy, and really it's mostly designed, and the goal is to control inflation. They'd rather have a soft landing, what's called a soft landing, and not put us in recession or, God forbid, a depression. But if you start seeing rising interest rates, that's more bear market and inflation fighting stuff. When they start to stop and maybe start reducing interest rates, these are things that can stimulate the economy and maybe put us back into a bull market, particularly in the supply chain, or excuse me, in the stock market. Which led me to the next thing I stumbled upon, which is supply chain issues. We're in this unique thing where, because of COVID and all that, and even now with China having real more strong lockdowns quickly to go back into lockdown, which hurts our supply chain, our movement of our goods and raw materials, which is hurting our ability to get products, but also that causes rising prices because there's limited supply. There might be a lot of demand, limited supply. Well, that's when prices start rising. That's inflation again. So those things impact it, and certainly global tension, certainly with Russia's invasion of Ukraine and other types of global tension, and there doesn't help anything too, as well, as far as getting a more comfortable environment and having a bull market go. Bull markets do well when there's not a lot of turmoil, whatever it might be, whether it's the coronavirus or a pandemic, to global tension or problems with inflation or interest rates or unemployment, all that stuff. Bull markets like it when there's predictable earnings, predictable stuff, and everything's kind of going forward. Another thing to watch for is there are some categories or sectors that are kind of early indicators of an early, maybe potential bull market coming. So some early bull market type sectors to look at to see when you start seeing some better results from these types of sectors is these are ones that are real sensitive to economic growth. When they start doing better, these are maybe indicators that a bull market might be coming. And these would be things like financials, banks and stuff, consumer discretionary, companies that provide non-essential goods or services, right? So I don't have to buy a Tesla if we're in a bad economic time. That's a discretionary thing for me as a consumer. There's, more mandatory things for consumers, like I do need to buy food. So during recessions and bear markets, food companies and food processors do better, utility companies, because I got to still heat my home, do better than consumer discretionary. But if you start seeing discretionary starting to rise and seeing better earnings from discretionary companies, that are consumer based, that's a good thing. And then also industrials are a good thing too. Companies like 3M and all that might show you an early indication that a bull market's coming. When we get to more of a mid-bull market where that's coming or starting to really emerge or it's starting to happen, that's when you start seeing technology do well. So technology is always going to lag a little bit more, risky or whatever. So you're going to see those real cyclical sectors, financials, the consumer discretionary industrials will start improving first, and then you'll see technology. And just some general things too. You'll start seeing more positive commentary in the news, right? The earnings are good, and some of the analysts are talking about, more positivity around what might be happening for the overall economic climate and for individual companies. And investor sentiment is starting to turn positive too. Maybe we had people pulled their money out of the stock market as an example, and they sit on the sidelines, so they capitulated and just, I'm throwing my hands up, I'm never investing in stocks again, I've lost too much money. And then if that sentiment starts turning positive again and you start seeing money flowing back in, so watch anything where people like Vanguard or Fidelity talks about that more new money is flowing into their exchange traded funds or mutual funds. And particularly in a sector like the stock market, let's say, for our example, we're looking at the stock market in terms of a bull market, that's a positive sentiment. As more money comes in, that'll help drive up stock price as well, because more buyers, wanting to buy and pay more than sellers. So that can be a good overall kind of just general feel indicator too as well, and start seeing those actual numbers of positive inflows coming into the area that's experiencing a bear market that may now be coming out of bear and headed towards a bull market. And if we talk about the stock market is considered a leading indicator. It means it's kind of like crystal ball-like or looking ahead, right, is the idea of the stock market. And it usually leads, typically, it's certainly what the experts say and professors would say, like 9 to 12 months. Research would say that too. So if stocks are rising now, that means better economic times, maybe bull market might be 9 to 12 months away. So where they start doing better, the stock market will start to do better before a big economic boom. And then while it's booming, of course, and the bull market is really going well and raging, then all the companies' earnings are doing better, their stock prices are doing better, and us as investors in these stocks are doing a lot better too in a bull market. Okay, so if you like this kind of stuff, hey, don't forget to hit that subscribe button, check out some of the other videos, and I have all sorts of educational stuff below too. But just start thinking about and watching for these kinds of things. Don't just assume like, oh, one company had good earnings, so the bull market's on. It's got to be more broad-based than that. But these are some indicators or some things to start watching for that when hopefully we'll start experiencing our next bull market and let the good times roll.